What if the difference between growing your money and losing it comes down to one simple principle: risk versus reward? Because in investing, there is no such thing as a no-risk opportunity. Every investment carries risk. The real question is not, is this risky? The real question is the reward worth the risk? And once you understand this, you stop investing emotionally and start investing intelligently. In simple terms, risk is the possibility of losing money. Reward is the potential gain from an investment. The relationship between the two is always connected. Low risk usually means lower returns. Higher risk can mean higher returns, but also a higher chance of loss. The key is not avoiding risk. The key is learning how to manage it. Let's start with something familiar. Keeping money in a savings account is considered low risk. Your money is safe, but the returns are usually very small. Now compare that to investing in stocks, real estate, or a business. These carry more risk, but they also offer the potential for much higher returns over time. So while savings protect your money, investments help your money grow. Understanding this balance is critical. Imagine two investors. Investor A is afraid of risk and keeps all their money in cash or a low-interest account. Investor B invests in a diversified portfolio of stocks and funds over time. Investor A feels safe, but their money barely grows and may lose value due to inflation. Investor B experiences ups and downs, but over the long term, their investments grow significantly. The difference? Investor B accepted calculated risk in exchange for greater reward. Starting a business is another great example. There is risk. You could lose money. The business might fail. Income may not be stable. But there is also reward, unlimited income potential, ownership of assets, control over growth. This is why many wealthy individuals own businesses. They understand that higher risk, when managed properly, can lead to higher rewards. Many people make the mistake of trying to avoid risk completely. They look for safe ways to grow money, but often end up keeping too much cash idle, missing investment opportunities, losing purchasing power to inflation. On the other hand, some people take too much risk without understanding it, chasing quick profits, trends, or hype, which often leads to losses. Both extremes are dangerous. Smart investors don't avoid risk, they manage it. They diversify their investments, do research before investing, think long-term instead of short-term, avoid emotional decisions, understand what they are investing in. Instead of asking, how fast can I get rich? They ask, what is the risk and is the reward worth it? A key principle is this: never risk what you cannot afford to lose. And always spread your investments across different assets. This reduces the impact if one investment underperforms. It's not about eliminating risk, it's about controlling it. In investing, risk is unavoidable. But ignorance about risk is what destroys wealth. The people who build long-term wealth are not the ones who take the most risk. They are the ones who understand it best. Because when you understand risk versus reward, you stop gambling and start investing with purpose. Start thinking like an investor today. Before putting your money into anything, ask yourself, what is the risk here? What is the potential reward? Does this align with my goals? Can I afford to lose this if things go wrong? Educate yourself. Diversify your investments. Stay consistent. And focus on the long term. Because wealth is not built by avoiding risk. It's built by taking calculated risks wisely. Investors often overlook the importance of research when exploring new opportunities. For instance, before choosing a specific stock, it's crucial to examine the company's fundamentals, such as its earnings history, market position, and growth potential. This analysis empowers you to make informed decisions rather than relying on fleeting market sentiment or social media buzz. Always ask questions like, is this company financially stable? Or, what are the industry trends? By doing your homework, you can identify viable investments that align with your risk tolerance and financial goals. Moreover, consider the role of time in your investment strategy. The longer your money remains invested, the greater its potential to grow due to the power of compound interest. For instance, if investor A had started investing even a small amount over the same period as investor B, the benefits of compounding might have drastically changed their financial situation. Instead of simply hoarding cash, by gradually entering the market, they could have leveraged those small risks into substantial rewards, highlighting the importance of time and patience in smart investing. In addition to thorough research and understanding time, it's essential to cultivate a disciplined approach to investing. This means setting clear investment goals, regularly reviewing your portfolio, and not reacting impulsively to market fluctuations. Establishing criteria for when to buy or sell can help maintain focus, ensuring decisions are based on rational analysis rather than emotional responses. By implementing a systematic strategy, you reduce the likelihood of making hasty mistakes that can erode your wealth. Consistency in applying your plan, especially during volatile periods, reinforces the commitment to managing risk effectively while remaining aligned with your long-term objectives. In addition to a disciplined approach, cultivating emotional intelligence can significantly enhance an investor's success. Recognizing and managing one's emotions during market fluctuations allows investors to avoid impulsive decisions driven by fear or greed. For instance, when markets experience downturns, maintaining composure and sticking to your investment strategy is crucial. Similarly, during market euphoria, resisting the urge to chase after unsustainable trends can prevent costly mistakes. Learning to read market sentiment objectively can empower you to stay the course, ensuring that decisions are grounded in careful analysis and strategic planning rather than reactionary impulses. This balance of emotional control and rational decision-making is a hallmark of successful investors. One pivotal aspect of investing is understanding the benefits of diversification. Spreading your investments across various asset classes, such as stocks, bonds, or real estate, can mitigate the risks associated with market volatility. For instance, if one sector underperforms, the gains from others can help cushion losses, allowing your overall portfolio to remain stable. By not putting all your eggs in one basket, you can enhance your chances of achieving consistent returns over time. Additionally, embracing a mix of investment styles, like value investing and growth investing, can further bolster your strategy. Ultimately, a well-diversified portfolio aligns risk with potential rewards, providing a structured pathway toward achieving your financial objectives. Investing in real estate serves as another illustrative example of risk and reward. The potential for substantial returns exists, especially when properties appreciate and generate rental income. However, it's essential to recognize the risks involved, such as market downturns, property management challenges, and unexpected expenses. Investors must assess these factors carefully, ensuring their ability to handle fluctuations. Developing a thorough understanding of local markets, property valuation, and the economic climate is crucial before committing funds. By combining research with strategic planning, real estate can complement a diversified portfolio and enhance wealth-building efforts over time. By maintaining a clear focus on your long-term objectives, you can also avoid becoming too attached to individual investments. Instead of viewing daily market movements as a reflection of your financial worth, recognize they are frequently temporary fluctuations. This perspective allows you to remain objective, making it easier to stick to your strategy. Investors who are willing to separate their emotions from their investments often find success through a more composed mindset, aiding them in navigating the inevitable ups and downs of financial markets. Embracing a disciplined approach helps generate a sense of stability, even amidst uncertainty, and empowers you to make decisions that align with your overarching goals rather than immediate market reactions. Utilizing a long-term perspective allows investors to ride out volatility, focusing on the overall growth trajectory rather than short-term setbacks. For example, during an economic downturn, it may be tempting to panic and sell off assets. However, history shows that markets tend to recover over time. By maintaining patience and confidence in your investment choices, you position yourself for potential recovery gains when the market rebounds. This enduring mindset is crucial as it helps avoid costly mistakes related to reacting impulsively to fleeting trends and emotional responses, reinforcing the importance of consistency in your investment approach. By cultivating this mindset, you empower yourself to navigate the complexities of investing more effectively. In conclusion, mastering the balance between risk and reward empowers you to build lasting wealth through informed decisions and intelligent strategies. By embracing calculated risks while remaining disciplined, you position yourself to unlock the full potential of your investments, ensuring a prosperous financial future. Start investing with purpose today